Good day to all, I'm 𝗪𝘆𝘀, an iFAST research analyst. In the aftermath of the global financial crisis, local government financing vehicles have emerged as the key force driving economic growth in China. They are structured as quasi-official investment entities, secured funding for infrastructure projects through the issuance of municipal bonds. However, the challenges surfaced with a downturn in the property market, which significantly reduced the primary income source, land use right sales, constituting 90% of total local government revenue. Consequently, it has hampered the local government's capacity to service the debt. To navigate this financial turbulence, LGFVs are collaborating with banks to restructure their debt at a discounted rate and with an extended maturity. While this approach provides a short-term respite for LGFVs, it could negatively impact the profitability and asset quality of banks, especially in a loose monetary macro environment where net interest margins are already squeezed. This trend is evident in the case of the Bank of 𝗪𝘃. China also responded by permitting local governments to issue low-cost refinancing bonds to retire high-cost LGFV debts. While the strategy eases immediate debt pressures, it exacerbates the already worrisome debt situation, bringing previously hidden debt onto the official balance sheet. Additionally, it does not decrease the total debt amount, and China may find itself reliant on perpetual debt rollovers, draining capital essential for economic growth over the decades. Furthermore, China raised its budget deficit from 3% to 3.8% and issued 1 trillion yuan of sovereign bonds. This decision is deemed necessary to stabilize the economy, yet the impact may be constrained given the diminishing marginal returns from already saturated infrastructure projects, yielding a mere 1.3%. Over-investing in infrastructure may divert resources from other industries requiring substantial capital to achieve economies of scale. While LGFV's debts may not be the immediate demise of China in 2023, the absence of structural policies to navigate a heavily indebted economy is apparent. Optimism for a swift rebound in China's consumption demand is met with caution, highlighting the need for a nuanced and sustainable approach to economic recovery. This leads to the view that MSCI China may not offer a good upside in the next 2 years. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Cyrus will talk about Standard Chartered bonds. Over to you, Cyrus.
Hello, I'm Cyrus, research analyst from the iFAST Bond Research team. In the realm of operational resilience, Standard Chartered or StanChart has exhibited a commendable performance, with a decent year-on-year increase of 6% in operating income in third quarter 2023. However, StanChart has also faced some headwinds, primarily from China-related impairments linked to China commercial real estate as well as Bohai Bank. These have led to downward pressures on StanChart's profits before tax. Although looking forward, management has retained guidance for operating income to grow at a solid 8 to 10% pace in 2024. Despite these hurdles, StanChart remains well capitalized, boasting key ratios that remain well within management guidance ranges and surpass regulatory minimums with healthy buffers. We think StanChart occupies a solid position as a stable player in this financial landscape. For investors seeking opportunities within StanChart's bond offerings, we recommend a closer look at the November 2025, January 2027, and February 2027 US dollar bonds. These issues stand out for their relatively shorter tenor compared to other StanChart issuances, as well as their decent yields of over 5.5%. To get a full analysis, scan the QR code or click on the link in the description below. That wraps up the sharing for this week. Catch us again next week for more investment ideas and updates.